This content is for educational and entertainment purposes only. It does not constitute investment advice.
Hello Trading IQ community, welcome back to another video where I'm going to show you the only indicator I use to find where support and resistance is actually located. Now hold on, you're probably thinking, well, I can mark support and resistance all over the chart. It's one of the most basic and easiest things to do. See, there's resistance here, support here, and it's pretty easy to find, but you're probably doing this wrong. Now see, we can pretty easily say that this swing high is probably a resistance point. There's going to be a concentration of liquidity here in the future. Traders are going to place their stop losses right above the candle. Everything that it requires in order for a support or resistance point to actually manifest. But I have a question for you, and it's important. Where in this candle is the actual resistance point? Where is liquidity going to actually cluster? And on the formation of this candle, where was the most volume actually traded? Now, it's not easy to figure that out by just looking at the candlestick. In fact, I would consider it impossible. But within this candlestick that formed the swing high, if we are able to figure out exactly where the most volume was traded, exactly where liquidity is most likely to cluster after this candlestick forms and price moves against it, that is the information that we're looking for when we mark support and resistance. Not just what the high of the candlestick was and mark that as resistance. Now, this is a very important note. When short traders place their stop losses in the future, generally what they're going to do is look at the high of this candle that forms the swing high and then start placing their stop losses above it. This way, if there is a breakout, if the liquidity shelf breaks, the short traders say that they're wrong and they get stopped out. It's very unlikely that short traders are going to place their stop losses in mass within the actual candle here that formed the swing high. But that doesn't mean that the greatest concentration of liquidity is going to be right at the top of this candlestick. While that is a very possible scenario, that does happen a lot. It's not always the case. And for us to be able to determine, without looking at an order book, where liquidity is most likely to cluster on this candlestick, that is when we use the indicator developed by Trading IQ called IQ zones. Now we're going to come right back to this example in a few seconds, but let's take a look at what IQ zones actually looks like. Now first, we have this pretty cool looking volume profile, and this is actually a segmented volume profile. So what this indicator does is splits the current market price range into fourths, fifths, or whatever you choose here in the settings, and creates a volume profile individual to each of those segments. That way, if there's one huge range on the price chart like there is here, it doesn't skew the volume profile and make it look like previously traded price areas had little volume and are of no consequence. That's the first important feature of IQ zones. Now next, what IQ zones does is it actually marks support and resistance, but not at the exact high price of a swing high or the exact low price of a swing low. Instead, what IQ zones does, and if we go back to our example where this swing high formed, is it looks all the way inside of this candlestick to determine exactly where the most volume was traded on this candlestick. Now, there is an important note for me to make. Just because we find where the most volume was traded on a candlestick does not guarantee that that is where liquidity is going to cluster in the future. However, what this information can reasonably tell us is where a lot of traders who did enter short here, where their break-even point is actually located, where they're going to start to panic. And for those short traders who use something like a trailing stop or move their stop loss to break even, who entered where the most volume was traded, this in itself can certainly trigger some stop losses. That said, even though liquidity is likely to cluster a little higher, and stop losses are certainly going to be placed above this swing high, This exact price level where you see these lines, where the most volume was traded, is still going to function as a level that short traders are likely going to want to defend. And for this reason, where the most volume was traded, even though it's not a guarantee that liquidity will cluster here, there's still a respectable chance in theory that this level is going to function as some sort of resistance if traded at in the future, even though it's actually at the bottom of the wick that formed the swing high. Funny enough, but this is information we really can't figure out on our own without an indicator like IQ zones, and that's exactly why I use it. Now, just to show you what happened after this level was marked, we can see there was another test here, a very close test here, and here, but ultimately price failed after the formation of this candle and this candle. Aggressive orders failed to effectively exhaust any of the clustered liquidity at this level, or even slightly beneath it on up to 3 honest attempts. Now, let's look at what happens if we don't have this information. We see a swing high. This is the most important price because we don't have any information to tell us otherwise. We know liquidity will probably cluster here and stop losses will be placed here, but price never even comes near this. And truthfully, none of this information can be acted on or serve as any sort of guidance when price isn't near it at all. But IQ zones is actually giving us information that is closer to price, and that can serve as an explanation for exactly why these highs failed to move price respectably higher around this zone. Now, IQ zone marks these levels all over the chart, where these swing highs form and where the most transactions took place within those swing highs and swing lows. And then you also have your segmented volume profile, which can show you various points of control inside segments of the market. Additionally, for any of these marked support and resistance levels, we have what we call IQ zones. Yes, IQ zones is the name of the indicator, but is also the name of some of the support and resistance levels that you see on the chart. Now, an IQ zone is marked by any of these triangles here that you see on the chart. And a support or resistance level, or basically a swing point, is eligible to become an IQ zone. It must meet one of two conditions. One, that support or resistance level formed on high volume in the first place, so there was a lot of interest at that level on its own. Or that support and resistance level formed within a high volume zone within the volume profile. And with this, even though we don't have direct access to the order book to see if there's clustered liquidity at any of these swing points, we can identify support and resistance levels that strictly formed on high volume or within a sequence of high volume. And this tells us exactly where support and resistance levels formed that generated a high amount of interest. And those are the levels that I'm personally concerned with, because when they're revisited in the future, I consider there to be a greater likelihood that we will see a strong reaction at the IQ zone, and that whether or not price breaks that level or reverses off of it, what happens afterwards will be volatile and will be exploitable inside of my trading plan. So if you're interested in IQ zones, be sure to check it out. It's free. We have it on TradingView. Links in the description. And if you haven't already, be sure to like, comment, and subscribe with notifications on so you always get 2 fresh new indicators each and every week. And if you're looking for a trading home, check out our Discord server where we have active traders talking each and every day. That'll be it for this video. Thanks for watching, and I'll catch you in the next one.